And Kelvin, we did see some selling a couple of days ago in the US and around the region, in fact. But do you feel to some degree markets lost sense of the bigger picture? I mean, the Fed's withdrawing support because the economy's strong. How does earnings growth look to you?
Well, I think the question right now is basically not when the Federal Reserve is actually going to hike, right? The Federal Reserve is going to hike. The bigger question is what is the magnitude of the hikes that we're going to get this year, and whether the pace and tightening with regards to the Federal Reserve shrinking its balance sheet, how is the magnitude of that actually going to figure as well? And I think these are the two reasons why the markets actually sold off pretty heavily in the last 2 days, because the Fed normalizing the balance sheet is a big thing. The balance sheet size is about $8.5 trillion. It's far bigger than what we had during the global financial crisis 12 to 13 years ago. And therefore, if the Fed were to normalize at its balance sheet right now, will it do so at a faster pace than before? And I think that's the way the markets are actually struggling to actually try to actually understand that. And that has actually resulted in the real yields moving up very sharply this week. And that in turn has basically hurt the tech sector.
Well, let's talk about some of the corporate fundamentals, though. How does the earnings picture look for you going forward? And are equities correctly valued on that basis at the moment?
Yeah. I think in the first quarter of the for the U.S. corporates as a whole, earnings might be affected a little bit because of the rise in the Omicron cases, and we've seen how some of the numbers coming out is actually reflecting that. For example, last night we had some of the data coming out a little bit softer than expected, but we do expect the pickup to continue in the second quarter. Once the Omicron variant cases start to actually peter out towards February and March, then perhaps consumption could actually come back and pick up for the slack that we've seen so far in the month of January. Now, if that's the case, that basically means that we could perhaps be set for a softer first quarter than expected, but in the second quarter, we do expect the spending to actually continue before it actually takes a breather in the third and the fourth quarter, because the excess savings that have actually been spent are probably likely to actually, the consumers are probably likely to have to go back to the normal disposable income after they've actually spent the excess savings in the first 2 quarters of this year.
We have seen a massive tech sell-off globally right now, given that bond yields continues to surge. Some resiliency, though, in those chip makers across Asia with the chip shortage as well. This GTV chart on the Bloomberg showing how value has really outperformed growth this year. Will this trend continue, and where do you see strength?
Yeah, I think this trend is likely to continue because we think that the 10-year yields in the US side is probably going to hit about 2% by the end of this year. And there's a real risk of that overshooting as well if the Federal Reserve starts to actually tighten the balance sheet, right, by normalizing its balance sheet. So what you're going to get is a picture of the real yields rising. That in turn is going to be not so good for sentiment on the tech sector, especially for the loss-making tech companies. Those are likely to be more vulnerable because, if in a world where you're flush with liquidity, you are flush with very, 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 very low interest rates, then all the risk assets tend to do really, really well. And, extreme risk assets also tend to do well. But now you have a situation where your cost of borrowing is actually increasing. And that in turn basically means that investors are likely to be more choosy, more selective as to where they want to put their money. And that means cutting the exposure into a lot of the riskier assets in that sense. So I think where the tech sector is concerned, if you are very overweight on the tech sector, it's time to actually pare that down. I would actually advise against adding to that. And in fact, we do think that a rotation into value will probably make a lot more sense at this point in time.
Does Chinese tech classify as risky assets given the regulatory crackdown, or could we see value given how much they've sold off?
Chinese tech is in a quite different cycle altogether on its own. We think that the worst is over, that the policy tightening risks are largely done. You might get a bit of fine-tuning of the measures to come, but I think the kind of overhaul in the Chinese regulatory sector that we saw, like for example in the after-school tutoring sector last year, we think most of that is already done. So if you're worried about the regulatory risk, I think you can actually be a little bit more comforted this year. But the problem is that you're probably not going to get a catalyst coming in until in the second or the third quarter of this year, largely because the credit easing that's going to come will probably come only towards the February and March period in a bigger way. And we think that that is actually crucial for the Chinese equities market to actually move. But in terms of valuations, the Chinese tech sector is very, very cheap. On a top-down basis, China actually underperformed last year. The H shares were down about 20% compared to the US equity space, where the S&P 500 was up about 30%. So on a relative basis, China looks really, really attractive based on its valuations.
So once the stimulus kicks in the latter half of next year for China, where would you go?
I think some of the tech stocks in China is actually very attractive. If you look at the usual consumer discretionary names in the tech sector, those are where we think there is a lot of potential for the share prices to actually move. On top of that, we also do like the smart mobility, the 5G space in China, because that's where a lot of the growth is. The growth potential of the Chinese tech sector is not in dispute. It's just that sentiment right now is very poor, and it's sentiment coming in from the property sector as well that's actually affecting the entire market. I mean, we must always remember that the Chinese tech sector are the biggest stocks on the index, and therefore, every time investors sell out of China, the tech sector takes a beating because they are simply the biggest components on the tech market, in the Chinese market.